What's up guys, welcome back to InvestingPH. So for this video, I'll show you the dividend stocks I've been buying these past few months. Now, some of you may wonder why a few of these stocks' dividend yield aren't that high. Well, to answer that, when I look for dividend stocks, I don't just simply look at how high its yield is. Before I invest in any company, it has to have good financials, growing revenue, net earnings, equity, that should be managed well, and of course, it should be trading at a discounted price. Without this combination, even though it has a good yield, I wouldn't be investing in it because dividend yield can be a trap. That company may be paying good dividends now, but it wouldn't be sustainable in the long run. What I want for the companies I invest in is for me to hold it for a long time and give me consistent dividends. So I'd rather choose a company that pays me a 2 or 3% yield rather than a company that has a yield of 10 to 20% but have high debts, negative equity and earnings growth, and is trading at a very high price. That's why if you look at my portfolio, it is a mixture of high and low yield dividend stocks because I don't just focus on yield alone. It must pass all the criteria in my checklist. Anyway, I've discussed this in my video on how to build a strong dividend portfolio. I suggest you watch it after this. Going to the first stock is the new addition to my portfolio, All Homes, a home improvement retailer. It's quite new in the market. It had its IPO late 2019, before the drop caused by the pandemic. It has expanded its business all over the Philippines. From 2016 of only 15 stores, have grown rapidly to 60 stores in 2022. If we check its earnings, it has grown quite well from 2016 and had a big growth in 2021, though a big drop in 2022. They have somewhat recovered in their latest 12 months, but let's see if they can continue this in the remaining months this year. But even with that, their 5 years compounded average growth is 18%. For their equity, they have grown consistently as well, having a 5.70% compounded growth for the past 4 years. As to how they are handling their debts, the current ratio is at 2.78. So for every 1 peso of current liabilities, they have 2.78 peso of current assets. This means they can easily pay up all their short-term debts with more room to spare. And for their debt to equity, it's only at 0.70. So for each peso of equity, they only have 0.70 of debt, which is very low. So we can easily say they are managing their debts well. For their dividends, although we only have a few years of data, since they are new to the market, the yield is 4.4% and they only pay 32% of their earnings, which is good since they still have more left to reinvest back into the company to grow their business. I don't like a company that pays all their earnings to their shareholders. That's why when I look at a company's dividend payout ratio, it should be at a reasonable percentage. Usually below 60% is what I look for. Exemptions are REITs, which are obliged to distribute most of their earnings to their shareholders. It is important for a company to further expand the business. That's why they shouldn't be paying all their earnings as dividends, because the more the company grow, the more chance they would increase their dividends. Now for All Homes, since 2021, they have grown their payout, so hopefully they would continue to increase this in the future. For its price valuation, P ratio is only 5.6, meaning its price is trading 5.6 times its earnings, which is quite low, because in comparison to Wilcon Depot, which has the same business as theirs, it is trading at 25.6 times its earnings. Same to its price to book ratio, which is only 0.4. In comparison to Wilcon Depot, which is trading 5.1 times its book value. This means All Homes is trading at a discount in comparison to its equity. Now for my computed intrinsic value, it's at 2.55. With a 30% margin of safety, my buy below price for All Homes is 1.78. Now before we head on to our next company, if you're wondering where I got the ratios and comparison graphs I'm showing, it is from Simply Wall Street. They have tons of data available for you, and it's so easy to understand. So if you're a beginner investor, this platform would definitely help you out. And for those who are having trouble keeping up with the stocks they own, then this platform also does the job for you. They update you on the stocks in your watch list from earnings release, dividends, insider buying or selling, or if the company falls below your computed buy price. And speaking of buy price, if you don't know how to compute it, they also have a computation for you. But of course, a warning, still do your thorough research about a company if it's really worth investing in or not. Don't just rely on the buy price alone. And there's more. They also have a portfolio tracker that lets you assess your portfolio's health, detailed returns, and a lot more. So if you want to try it out, you can head down below and sign up using my link. They offer their basic plan forever free, and if you do avail of their paid plan using my link, you can get 30 and even up to 40% discount. So what are you waiting for? Level up your investing journey with Simply Wall Street. Now back to the video. Next up is DNL. Now, I've shown DNL a lot of times in my videos, and I was able to buy another round of shares when it went below my average price for it. This company has a diverse set of businesses, from food ingredients, oleochemicals, specialty plastics, consumer products like aerosols, personal care, etc. They had been around for 60 years, and they have a monopoly in their line of business, serving the biggest brands like Boysen, KFC, Jollibee, McDo, Nestle, Shakey's, Universal Robina, Petron, and a lot more. That's why I really like this company. They have a strong moat. If you look at their financials, they aren't left behind as well. Earnings have grown from the past 10 years, although there was a slight setback in 2019 because of the China trade conflict and the pandemic. They've already managed to recover and have surpassed their pre-pandemic earnings. This gives them a 10-year compounded growth of 11.26%. And their revenue as well have grown exponentially by 21.17% compounded growth for the past 10 years. As for their equity, they're consistently growing. This is with a 10-year average compounded growth of 9.91%. As to how well they're handling their debts, current ratio is only 1.51, which means they can easily pay up all short-term obligations. Debt to equity is only 0.97, which is quite low. This means not only does their earnings and equity are growing, but they are also managing their debts well. For their dividends, their yield is 4.1% and their payout ratio is only 55%. As for their history, they have increased their payout since 2015. So with how well DNL is doing financially, we can forecast that it has a high chance of increasing their dividends in the future. For price valuation, P ratio is 16.8 and their price to book is at 2.5, which is quite high. But when we look at the nature of their business, I can't see any competitor in their field. That's why even though it's trading slightly high in terms of its earnings, I'm still investing in it since they have a strong moat for me, which I think in time this company still have a lot of room for growth. But of course, even though I like the company, I would still follow my buy price. My computed intrinsic value for DNL is 27.19, and with a 30% margin of safety, my buy below price is 7.34. This is an updated version since we already have 2022's earnings. Next up, you may be surprised that I treat this as a dividend stock. Megaworld. Well, though it doesn't have a high yield, the company's financials are strong, and due to its price plummeting hard, its yield has increased to a good amount. Megaworld is a real estate company. Their business can be divided into real estate such as townships and residences. They have offices, malls, and hotels. For their financials, net income pre-pandemic has grown smoothly. Now in 2014, that went high like that due to a one-off gain, which happens to some companies. Though in 2022, they still have yet to recover past their pre-pandemic earnings, they are somewhat inching their way up. We can already see the recovery when you go to malls, and since offices are now open again, I think this company would recover soon. But even with that, their 10-year average compounded growth is 6.31%. As for their equity, they are consistent in their growth, growing at a compounded average of 12.94% for the past 10 years. And as to how well they're handling their debts, current ratio is 2.98, meaning they can easily pay all short-term obligations with a lot to spare. Debt to equity is at a low of 0.70, which means Megaworld is handling well their debts. For their dividends, though it isn't high, it's still at 3%, which is not bad, and they only pay 14% of their earnings to their shareholders. And if you look at their dividend history, they have increased along the years, at which if they recover their earnings, their payout would definitely go up. For their price valuation, P ratio is only 4.4. In comparison to its peers, it's really trading at a discount. Price to book as well is only 0.3, which means we are buying their equity at a huge discount. This means for every 1 peso of Megaworld's equity, if we buy right now, we are buying it for only 0.3 peso. If we compare it to its peers, it's at a discount. Now for my buy price, my computed intrinsic value is 4.57, and with a 30% margin of safety, my buy below price is 3.2. The last dividend stock I'm buying is Security Bank. There's not much to tell about its business, it's just like any other bank. Now most bank companies here in the Philippines were hit hard by the pandemic. This led to their stock price plummeting hard. As we go to their financials, earnings though fallen during the pandemic have recovered in 2022 and have actually surpassed their pre-pandemic earnings. They have grown at a 10-year average compounded rate of 7.73%. For their equity, the same. Although have slowed down a bit, they've managed to continue their positive growth. This is with a 10-year compounded average growth of 13.07%. For debts, banks usually have high debt ratios. That's why it isn't accurate to assess banks like normal companies. But one thing I look at is the loans to deposit ratio, which checks a bank's liquidity for any unforeseen fund requirements, like a sudden withdrawal. This is what happened in some US banks because of panic. People started withdrawing their money. Banks should have enough liquidity to cover this. But one thing to take note of is, a too low ratio of this may mean the bank isn't using the money it has to earn more. That's why usually it's around the 80 to 90% range. For Security Bank, it's around 89.7%, so well within the standard. For dividends, their yield is at 3.6%, and they only pay 22% of their earnings to their shareholders. And for their payout history, from 2013, they slightly increased their payout. For their price valuation, price-to-book ratio is what I look at for banks. Security Bank only has a ratio of 0.5. In comparison to its peers, it's still on the discounted side. And as for my buy price, my computed intrinsic value is 141.67. With a 30% margin of safety, my buy price is 99.17. With that, this ends this video for today. Now I know there are still a lot of companies in the Philippines that have a higher dividend yield than these companies, but always remember to not just focus on yield alone. You have to assess first if the company you will be investing in can easily maintain that payout in the long run. With that, I hope you've learned something from this video, and if you did and still haven't clicked the like button, be sure to do so before you leave. Thank you and see you in the next video.